Right now, somewhere in the world, someone is sitting in front of multiple screens watching numbers move. They are not a banker. They are not a hedge fund manager. They might be in a bedroom, a coffee shop, or a spare room with blackout curtains and 3 monitors. And in the next few hours, they will either make more money than most people earn in a month, or they will lose everything they put in. This is day trading, and the real answer to how it works is far stranger than most people expect. To understand day trading, you first need to understand what a financial market actually is. At its most basic level, a market is just a place where buyers and sellers agree on a price. When you buy a stock, you're buying a small piece of ownership in a company. The price of that stock changes constantly based on what people believe the company is worth at any given moment. And that belief shifts every second of every trading day based on news, earnings reports, economic data, rumors, fear, greed, and the collective psychology of millions of people making decisions simultaneously. Day trading is the practice of buying and selling financial instruments within a single trading day, not holding them for months or years the way traditional investors do. Buying in the morning, selling by afternoon, and ending the day with no open positions. The goal is to profit from small price movements that happen over minutes or hours rather than the gradual appreciation that long-term investors wait for. The instruments day traders use vary. Some trade stocks, some trade options, which are contracts that give you the right to buy or sell a stock at a specific price before a certain date. Some trade futures, which are agreements to buy or sell an asset at a predetermined price at a specified time in the future. Some trade currencies in what is called the Forex market, the largest financial market in the world, where trillions of dollars change hands every single day. The common thread is speed. Everything in day trading happens fast. Here is how a basic stock trade works. You identify a stock you believe is about to move in a particular direction. Maybe a company just released strong earnings. Maybe there is news that affects an entire sector. Maybe a technical pattern on a chart suggests a breakout is coming. You place a buy order through a brokerage platform. The order gets matched with someone willing to sell at that price, and the transaction happens in milliseconds. If the price moves in the direction you predicted, you sell at a higher price and pocket the difference. If it moves against you, you either take a loss or wait, hoping it recovers. In day trading, waiting too long almost always makes things worse. The mechanics seem simple. The execution is extraordinarily difficult. Researcher Brad Barber and Terrance Odean at the University of California published one of the most comprehensive studies ever conducted on individual traders, analyzing the performance of tens of thousands of accounts over multiple years. Their findings were stark. The vast majority of active traders underperformed the market. Most lost money, and the more frequently someone traded, the worse their returns tended to be. In a follow-up study specifically examining day traders in Taiwan, they found that fewer than 1% of day traders were consistently profitable over a sustained period. So why does anyone do it? Part of the answer lies in something called the bid-ask spread. Every financial instrument has two prices at any given moment. The bid price, which is what buyers are willing to pay, and the ask price, which is what sellers are willing to accept. The difference between these two numbers is the spread. Every time you make a trade, you are paying this spread as a hidden cost. On top of that, most brokerages charge commissions, and in many countries, profitable trades are taxed as short-term capital gains, which carry higher rates than long-term investments. For a day trader, these costs add up with every single transaction, meaning you need your winning trades to significantly outpace your losing ones just to break even. The tools day traders use to find opportunities are called technical analysis and fundamental analysis. Fundamental analysis involves examining the underlying financial health of a company, its earnings, revenue, debt levels, and growth prospects. Technical analysis involves studying price charts and trading volume to identify patterns that have historically preceded certain price movements. Concepts like support and resistance levels, moving averages, relative strength index, and candlestick patterns form the vocabulary of technical traders. The debate over whether these patterns actually predict future price movements or are simply human beings finding shapes in noise has never been fully resolved. There is also the question of who you are trading against. When a retail day trader places an order, the counterparty on the other side of that trade is often not another retail trader. It is frequently a market maker, a professional firm whose entire business is providing liquidity to markets. These firms have access to faster infrastructure, more sophisticated algorithms, and better information flow than any individual trader sitting at home. High-frequency trading firms execute millions of trades per second using algorithms that can detect and respond to market movements faster than any human can perceive them. Competing against these entities with a laptop and a retail brokerage account is, for most people, the financial equivalent of challenging a professional chess grandmaster to a game you learned last week. And yet, the stories persist. The accounts of people who turn small amounts of money into substantial wealth through trading are real. They exist. What the survivorship bias tends to obscure is the far larger number of people who attempted the same thing and quietly disappeared from the conversation after losing their savings. The psychological dimension of day trading is where things get particularly interesting. Loss aversion, a concept developed by psychologists Daniel Kahneman and Amos Tversky, describes the well-documented human tendency to feel losses approximately twice as intensely as equivalent gains. This means a trader who loses $100 experiences roughly twice the emotional pain of the pleasure from winning $100. In practice, this creates a devastating pattern. Traders hold losing positions too long, hoping they will recover, and sell winning positions too quickly, afraid of giving back gains. This is exactly the opposite of what profitable trading requires. The discipline required to cut losses quickly and let winners run sounds simple in theory. In practice, it requires overriding deeply wired emotional responses that evolve for a very different environment than financial markets. Risk management is the one thing that separates traders who survive from those who do not. Professional traders talk about never risking more than 1 or 2% of their total capital on any single trade. They set stop-loss orders, automatic instructions to sell if a price falls below a certain level, limiting the damage any single bad trade can do. They keep detailed records of every trade, analyzing what worked and what did not. They treat trading as a business with rules, not as a gambling operation where gut feelings drive decisions. The brokerage platform itself deserves attention. Modern retail trading platforms have made it possible for anyone with a smartphone and a few $100s to access financial markets. Companies like TD Ameritrade, Interactive Brokers, and others have reduced or eliminated commissions on stock trades, making the mechanical cost of trading lower than it has ever been. The availability is a double-edged development. It has democratized access to markets that were once reserved for professionals. It has also made it trivially easy for unprepared people to risk money they cannot afford to lose in an arena where the odds are genuinely stacked against them. So how does day trading actually work? Mechanically, it works through platforms connecting buyers and sellers, price discovery happening in real time, and traders attempting to profit from short-term price movements using a combination of analysis, speed, and discipline. In practice, it works as a brutal filter. The small percentage of traders who develop genuine edge, real risk management, and the psychological resilience to execute a strategy without letting emotion override it can build something sustainable. For the majority, it works as an expensive education in probability, human psychology, and the gap between what markets appear to offer and what they actually deliver. Right now, someone is sitting in front of those screens watching numbers move. Some of them know exactly what they are doing. Most are still learning what day trading actually costs.